In an era of information overload and volatile markets, where the siren call of quick money often drowns out reason, there exists a timeless wisdom that allows individuals to not only withstand, but thrive. This wisdom comes from Bernard Baruch, an American financier, statesman, and advisor to presidents, who amassed millions on Wall Street and famously sidestepped the catastrophic crash of 1929. He earned the moniker the Lone Wolf of Wall Street for his fiercely independent thinking and his refusal to align himself with the era's powerful financial houses. This video will delve into the essence of his lone wolf method and explore 7 investment principles that remain profoundly relevant for traders and investors navigating today's complex financial landscape. Baruch's approach wasn't about secret formulas or insider tips. It was about cultivating a mindset of detached objectivity and rigorous self-reliance, a counter-narrative to the prevailing herd mentality that often dictates market movements. The core of Baruch's lone wolf method is rooted in independent thinking and a staunch resistance to the herd instinct. Baruch firmly believed in the imperative of forming one's own judgments rather than blindly following the crowd. He understood that market movements are driven not solely by economic fundamentals, but significantly by collective human psychology, the euphoria of a boom and the despair of a bust. To Baruch, succumbing to the emotional tides of the market was a guaranteed path to ruin. He observed how easily fear and greed could sway even seasoned investors, leading to irrational decisions that had little basis in objective analysis. This independent streak wasn't just a preference, it was a fundamental pillar of his success, allowing him to see opportunities and dangers that were obscured to those swept up in mass hysteria. He often noted that the market's biggest mistakes were made when everyone agreed on the next move, indicating a peak of sentiment rather than a peak of value. Crucial to this method was the importance of emotional distancing. Baruch would often physically remove himself from the frenetic energy of Wall Street, retreating to the quiet solitude of his country estate to make critical decisions. This deliberate act of separation was not merely for peace and quiet. It was a conscious effort to cultivate a state of detached objectivity. He keenly recognized that the most formidable challenge in investing is separating one's emotions, fear, greed, hope, panic, from rational, data-driven decisions. The noise and constant chatter of the trading floor, the endless stream of opinions and forecasts, could easily cloud judgment. By creating this physical and mental distance, he could assess situations with a clear head, free from the immediate pressures and emotional contagion that permeated the financial district. This ability to step back, analyze, and reflect without the immediate influence of market sentiment was a powerful advantage, allowing him to identify genuine trends and avoid speculative bubbles. He understood that the market often presents its greatest opportunities when others are most afraid, and its greatest risks when others are most confident. The lone wolf method also emphasized critical thinking and the relentless pursuit of hidden signals. Baruch's genius lay in his ability to discern that extreme market sentiments often serve as reliable indicators of an impending reversal. When optimism reached a fever pitch and everyone from the shoeshine boy to the seasoned banker was touting the next big stock, Baruch saw a warning sign. Conversely, when panic gripped the market and assets were being dumped indiscriminately, he recognized potential buying opportunities. He didn't just look at the numbers, he looked at the human element, the collective mood, and how it distorted rational valuation. This contrarian approach required immense discipline and confidence in one's own analysis, especially when going against the prevailing tide. It meant questioning assumptions, digging deeper than surface-level headlines, and understanding the psychological undercurrents that moved prices. This wasn't about being contrarian for contrarianism's sake, but about using the crowd's emotional extremes as a psychological barometer for market turning points. Now let's explore 7 investment tips from Bernard Baruch and how their timeless wisdom resonates with today's investors. 1. Thorough research before investing. Baruch's advice was unequivocal. Before you buy a security, find out everything you can about the company, its management and competitors, its earnings and possibilities for growth. He viewed a stock not merely as a ticker symbol, but as a proportional share of an actual business, one that demanded deep understanding. For Baruch, investment was not a gamble, but a calculated commitment based on fundamental value. He would delve into annual reports, industry analyses, and news articles, scrutinizing every detail to build a comprehensive picture of the company's health and prospects. This meticulous approach allowed him to identify businesses with intrinsic value rather than chasing speculative trends. He understood that superficial knowledge often led to superficial returns, or worse, significant losses. The relevance of this today is paramount. In an era where information is abundant but often superficial or misleading, deep fundamental analysis remains the bedrock for value investors. The Internet provides unprecedented access to company financials, analyst reports, and news, yet many investors still fall prey to hype and social media narratives without conducting their due diligence. Baruch's principle compels us to cut through the noise and identify real value, distinguishing solid businesses from fantasy stories with shaky foundations. It means understanding a company's business model, its competitive advantages, its debt structure, and its management team's track record. Without this groundwork, investments are little more than speculation, driven by hope rather than informed conviction. This principle is especially critical in sectors like technology or biotechnology, where rapid innovation can obscure underlying financial realities. A thorough understanding allows investors to hold firm during market corrections, confident in the long-term prospects of their well-researched holdings. 2. Beware of insider information and rumors. Baruch's warning was stark. Beware of barbers, beauticians, waiters, anyone who brings gifts of inside information or tips. Over time, Baruch grew increasingly distrustful of any purported insider information. He understood that by the time such a tip reached the general public, it was either too late to act profitably, or it was deliberately misleading. True insider information is rarely, if ever, freely disseminated to strangers, and often comes with legal and ethical implications. Baruch learned through experience that reliance on such rumors was a dangerous shortcut, leading to poor decisions based on unreliable sources. He preferred to trust his own research and analysis rather than the whispers of the crowd, which often served to benefit those spreading the rumor rather than those acting upon it. This advice is incredibly pertinent in today's digital age. With the proliferation of social media platforms, online forums, and instant messaging apps, the torrent of unverified information and crypto tips is overwhelming. Anonymous sources, self-proclaimed gurus, and pumped-up narratives can quickly lead naive investors astray. Relying on rumors, whether from a friend, a forum, or a finfluencer, inevitably leads to emotional rather than rational decisions. Such information often lacks context, is incomplete, or is outright fabricated to manipulate market sentiment. Baruch's caution reminds us that credible investment decisions stem from verifiable facts and independent analysis, not from unconfirmed gossip. The temptation to find an easy shortcut is powerful, but the consequences of acting on unverified information can be severe, leading to significant financial losses. Speaking of understanding the intricate dance of financial markets and the personalities that shape them, many investors today could benefit from a deeper dive into the historical context of Wall Street. It's not just about current trends, it's about recognizing patterns that repeat through history. For those who appreciate how the past illuminates the present, and who seek to understand the grand narratives and individual dramas that define financial history, you might find immense value in a particular work. 50 Years in Wall Street offers an unparalleled journey through half a century of market history, from the panic of 1857 right up to the Gilded Age. These illustrated memoirs by Henry Clews provide a vivid first-hand account of the titans of finance and the market manipulations that defined an era. It's more than just a history book. It's a window into the minds and methods of the past, offering lessons that, like Baruch's, remain strikingly relevant. If you're looking to enrich your understanding of market psychology and the enduring nature of financial cycles, this two-volume set is an invaluable resource. You can explore more about this fascinating historical account and how it connects to the enduring principles of investing by checking the link in the description. 3. Don't try to buy at the bottom and sell at the top. Baruch famously stated, "Don't try to buy at the bottom and sell at the top. This can't be done except by liars." He emphasized that perfectly timing the market is a futile endeavor. The illusion of precision, the belief that one can consistently identify the exact turning points of market cycles, is a dangerous fantasy. Instead, Baruch advocated for a more pragmatic approach, recognizing general trends and acting within reasonable proximity to market highs and lows, rather than chasing elusive perfection. He understood that trying to extract every last dollar from a trend often led to missing the broader move, or worse, being caught on the wrong side of a reversal. His focus was on capturing the significant middle portion of a trend, leaving the extremes to those who deluded themselves with perfect foresight. This advice directly counters the pervasive temptation of market timing, a strategy that frequently leads to investor underperformance. Countless studies have shown that attempting to time the market is incredibly difficult, even for professionals, and often results in investors missing the best performing days. Instead, investors should concentrate on long-term strategies, such as dollar-cost averaging and consistent investment, rather than attempting to guess short-term market movements. The goal should be to participate in the market's long-term growth, accepting that perfect entry and exit points are unattainable. This requires patience and a disciplined approach, resisting the urge to jump in and out based on daily fluctuations. Baruch's wisdom encourages a focus on the broader investment thesis and the long-term value of assets, rather than the fleeting hope of perfect timing. 4. Learn to cut your losses quickly. Learn to cut your losses quickly and cleanly, Baruch advised. Don't expect to always be right. If you made a mistake, cut your losses as soon as possible. Baruch himself learned this principle through painful experience, notably a significant loss during speculation in the coffee market. He understood that clinging to a losing position, fueled by hope or stubbornness, could turn a minor setback into a catastrophic one. The ego often plays a detrimental role here, making investors reluctant to admit they were wrong. However, Baruch recognized that successful investing required the humility to acknowledge errors and the discipline to act decisively to preserve capital. He saw capital preservation as paramount, understanding that a string of small losses was preferable to a single devastating one. This is a critically important principle of risk management for both traders and long-term investors today. The use of stop-loss orders, whether physical or mental, is a practical application of this advice, limiting potential downside. Beyond the technical aspect, the psychological readiness to admit mistakes and liquidate a losing position is key to capital preservation. Many investors hold on to baggage, underperforming stocks, hoping they will recover, often to their detriment. Baruch's principle teaches us that capital is a finite resource, and it should be redeployed to more promising opportunities rather than being tied up in failing ventures. It fosters a mindset of continuous learning and adaptation, where mistakes are seen as lessons, not as personal failures to be hidden or ignored. This principle is especially vital in fast-moving markets where trends can reverse quickly, making swift action essential. 5. Always keep a portion of capital in reserve. Baruch's steadfast rule was, always keep a significant portion of your capital in reserve. Never invest all your funds. Cash, for Baruch, was a financial guardian angel, shielding him from unexpected economic storms and simultaneously positioning him to capitalize on emerging opportunities. He recognized that market downturns, while painful for many, were often the most opportune times to acquire undervalued assets. Without a cash reserve, an investor is forced to sit on the sidelines, or worse, to sell existing holdings at a loss to meet liquidity needs. This reserve wasn't just about safety, it was a strategic asset, providing flexibility and power during times of market distress. He understood that even the best opportunities are useless if one lacks the capital to seize them. The relevance of maintaining liquid funds is profoundly evident today, particularly given the unpredictability of global events and economic cycles. Having a cash reserve allows investors not only to weather market downturns, but also to possess the crucial ability to buy when there's blood in the streets, as the old adage goes. This strategic liquidity can transform market crises into periods of immense opportunity for those prepared to act. Furthermore, a cash buffer provides psychological comfort, reducing the pressure to make rash decisions during volatile periods. It empowers investors to be patient, waiting for truly compelling opportunities rather than feeling compelled to invest every last dollar in a less than ideal setup. This principle extends beyond just investing. It's a fundamental tenet of personal finance, ensuring readiness for unforeseen expenses or economic shifts. 6. Invest only in what you know well. Circle of competence. Don't try to be a jack of all trades in investments. Stick to the field you know best, Baruch advised. He concentrated his investments in industries he understood intimately, such as sugar, rubber, and public utilities. This wasn't about limiting his scope. It was about maximizing his informational edge. By focusing on areas within his circle of competence, he could conduct deeper analysis, better assess risks, and make more informed decisions than if he spread himself thin across unfamiliar sectors. He understood that true expertise provided a significant advantage, allowing him to discern genuine value and potential from mere speculation. This focused approach minimized the likelihood of making mistakes due to ignorance or a lack of understanding of complex business models. This principle, famously championed by Warren Buffett as well, serves to significantly reduce investment risk, as risk comes from not knowing what you're doing. In today's rapidly evolving technological landscape, with new industries and complex financial instruments constantly emerging, adhering to one's circle of competence is more critical than ever. It helps investors avoid the trap of investing in hyped, yet poorly understood trends. For example, if you work in healthcare, you might have an intrinsic understanding of pharmaceutical companies or medical device manufacturers that an outsider would lack. This deep industry knowledge allows for a more nuanced evaluation of a company's competitive position, future prospects, and potential regulatory hurdles. By staying within their area of expertise, investors can make more confident and rational decisions, rather than chasing every new fad that appears on the market. To truly grasp the dynamics of Wall Street, one must look beyond individual tips and understand the broader ecosystem, the historical context, the key players, and the dramatic events that have shaped its evolution. It's a world rich with stories of triumphs and failures, innovation and crisis, and the enduring human element that drives it all. For anyone seeking to deepen their understanding of this fascinating world, and who enjoys compelling narratives about the people and moments that defined financial history, there's an excellent resource. The YouTube channel Wall Street Memoirs offers captivating insights into historical events, major financial crises, and the extraordinary figures who left their indelible mark on Wall Street. It's a perfect complement to Baruch's individual advice, providing the backdrop against which such wisdom emerged. By exploring these stories, you gain a richer perspective on market cycles and the timeless principles of investing. We highly recommend subscribing to Wall Street Memoirs for more engaging content on the rich tapestry of financial history. You can find the link to the channel directly in the video description below. 7. Sell when good news about the market hits the front pages. Baruch's contrarian advice was pointed. When good news about the market hits the front page of the New York Times, sell. He believed that by the time news became common knowledge and reached the mainstream media, the market had already reacted and prices had likely reached their peak. This was a clear signal of widespread public enthusiasm, often indicative of an overbought market ripe for correction. Baruch understood that markets move on anticipation, not on confirmed events. Once a positive development was fully priced in and widely celebrated, there was little room left for further upside, and significant downside risk began to accumulate. This principle encapsulates his lone wolf philosophy perfectly, urging investors to act against the prevailing sentiment when it reaches an extreme. This is a vivid illustration of Baruch's contrarian lone wolf strategy. In today's hyper-connected world of modern media and social networks, this effect is amplified exponentially. Hype now spreads at lightning speed, making it an even more reliable indicator of market overheating and a potential reversal. The famous anecdote of the shoeshine boy giving stock tips perfectly illustrates this principle. When even the most unlikely sources are confidently offering investment advice, it's often a sign that the market is at an unsustainable peak. It signifies that speculative fervor has replaced rational assessment, and smart money is likely already exiting. This doesn't mean ignoring all good news, but rather critically assessing whether the news is truly new information, or merely the culmination of a trend that is already fully priced into the market. It encourages investors to be skeptical of universal optimism and to consider taking profits when the euphoria is at its highest. In summary, the enduring wisdom of Bernard Baruch, the lone wolf of Wall Street, lies in his unwavering commitment to independent thinking, emotional discipline, rigorous analysis, and the courage to act against the prevailing crowd. His principles are not merely a set of rules, but a foundational philosophy for cultivating a resilient and successful investor in any market condition. They challenge us to look beyond the immediate noise, to question assumptions, and to trust our own informed judgment above all else. These time-tested principles are not just historical relics. They are a blueprint for navigating the complexities of modern finance. Baruch's advice proves that achieving financial success doesn't require genius or secret algorithms, but rather the consistent control of one's impulses and the steadfast maintenance of a calm, rational mind. His legacy encourages us all to embrace the lone wolf within, fostering the discipline and foresight necessary to build lasting wealth. The market is an ever-changing beast, but the human psychology that drives it remains remarkably constant. By understanding and mastering our own biases, and by adhering to sound fundamental principles, we can, like Baruch, find our own path to prosperity. As we reflect on Baruch's emphasis on psychological discipline and the importance of learning from the giants of finance, there's another legendary figure whose experiences offer profound lessons in market psychology and trading strategy. His story, told through his own words and meticulously analyzed, provides a direct link to the emotional and tactical challenges faced by every investor. For those who seek to truly master the psychological game of the markets and learn from one of history's most fascinating traders, we highly recommend the new edition of Reminiscences of a Stock Operator. This isn't just a reprinting of Jesse Livermore's classic. It's an enhanced edition that offers a deep analysis of his psychology and strategies, complemented by insightful commentary and analysis for each chapter. This transforms his historical experiences into practical, actionable lessons for today's market participants. It bridges the gap between historical narrative and contemporary application, making Livermore's wisdom accessible and relevant. If you're ready to dive into the mind of a trading legend and extract timeless lessons for your own investment journey, you'll find the link to this essential read in the description below.